So welcome along to the second week. Glad to see so many of you decided to come back for a repeat visit, which is nice. What we're going to be looking at today is the first bit of technical content in the subject. Last week was setting things up, starting to think about the environment. This week we're starting to actually get into some numbers. We're looking at the actual regulation itself. But, don't know why that happened, but before we get there, I actually would like to tell you a little bit of a story. Might take too long. It is actually relevant to what we're doing. And I hope that will become apparent as we go through. Now, a few years ago, I used to play sport quite a fair bit, played a lot of rugby, sort of stopped, and have been running a fair bit now. Now, this story a couple of years ago really caught my attention, and it will become apparent, hopefully, as to why that is. So this is a story about the Gold Coast Marathon back in 2011. Now, I've never run the Gold Coast Marathon. I have run a marathon once before, and it was bloody difficult. This guy here, Nicholas Manza, is a Kenyan runner, and he won the Gold Coast Marathon in 2011. Now, the good thing about winning a marathon is you make some money. They have prize pools for this sort of thing. They get some money for winning that. Now, the additional thing that the Gold Coast Marathon has, or at least did have, they had it in this year, was that if you were able to beat 2 hours, 10 minutes for the course, so 2 hours, 10 minute flat, which is pretty quick, you know, I would come nowhere even close to that, you pocket $20,000. But you make it, you make 20 grand. He won it that year. He's made 10 or 15 grand on the winner's purse. He's missed 2 hours, 10 minutes. How close do you think he got? What time do you think he came in at? To start throwing just any sort of numbers. 2 seconds, so 2 hours, 10 minutes, and 2 seconds. No, he didn't. He was actually closer than that. He came in at 2 hours, 10 minutes, and 1 second. He missed out on $20,000 over 42 kilometers, over 130 minutes of running by 1 second. That'd piss you off. Now, the reason I bring this up, and it will become, and we'll talk a little bit more about it and the impact it has for what we're doing, is that's a target for him. That's a target, that's an explicit target, 2 hours, 10 minutes. Now, he missed that target. And there was a benefit from there. There was an incentive to reach that target. He missed it. Now, the thing is, he has no way to change his time. That is done by independent timekeepers. He cannot come back after the race and say, oh, hang on, like, you know, the wind was a bit much in that little section. You know, that's a second. Come on, give it to me. He can't do that. He has to just take what the time was. Thing is, when we come to corporate reporting, it's not like that. When we come to corporate reporting, there are targets, and we're going to see a few more today. But management have the ability to make adjustments to those numbers. Even though they are numbers, and you kind of get this feeling that a lot of people think if it's a number, it must be objective. If you go and check out whatever, you know, whatever a movie rating is, and it's 4 out of 5 stars, somehow that's objective. Even if it's average across a lot of people, doesn't necessarily have to be the case. So we're going to look at situations, and we're going to look at ways and means in which this happens. So it is important to take into account that targets are everywhere around us, and companies do have the ability to make adjustments to the numbers that they're presenting. But as last week, I just want to stress that just because they can doesn't mean they always do. Yes, it does happen from time to time. We're going to see some examples of that, but it doesn't mean it always happens. So, I might stop that door being used. So where we're going with this, so we're going to be looking at the framework definitions of income and expense. This sets up the scene. The framework aren't the rules, but it gives us an idea of what we should be looking at. We're going to look at the information content of earnings, which is basically saying do accounting numbers, and in this case do income, profit, earnings, whatever you want to call them. Do these actually tell us something? Because if they don't, we might as well not be here. So you can kind of guess what the answer to that is already. But we're going to have a look at it in a little bit more detail. What incentives there are to adjust earnings starts to link back to old Nicholas's case there. We're going to have a look at the role for regulation, and then we're going to start getting into the regulation. I need to talk about this offline, so we're not worried about policy selection today, but revenue we'll touch on and construction contracts we'll touch on. Now, sport and, no, this is accounting. You're happy to stay. All right. This is from Qantas's 2014 annual report. Now, it is probably a little bit small for you guys to see it all. There is a handout. Well, I've actually made the full annual report available online. I would urge you to go and have a look at it. But in essence, I'll just sort of break down the areas that we're going to be touching on. And there are a couple of important points to take from all this. Firstly, a lot of what's on this we will be talking about in some way, shape, or form. But there is also another statement here which I didn't include in the slides and I didn't tell you to bring along, which is also important, and I'll talk about that. So the consolidated income statement, this is what we're going to be talking about, that first block of it, revenue. That's what we're interested in explicitly today. Week 3, if you have a copy of it or want to look back at a later point in time, depreciation, amortization, impairment of specific assets, impairment of cash generating unit. Week 3, I should probably have added a week 4. So that's the next 2 weeks. We'll be talking about areas in that sort of middle section, talking about non-current assets. Week 6, we're going to start looking at provisions and liabilities, and we're going to start looking at employee benefits. So manpower and staff related start to feature in there. Week 10, we're going to look at financial instruments. I'm pretty sure it's week 10. Financial instruments, so we're going to start looking at those type of items. Week 12, we're going to look at tax. A lot of these things start to feature in what we're looking at. So it's just an overview of where we're going over the rest of the course. Any of you guys doing ABC or have done ABC? Equity method investments, non-controlling interests also feature on statement of financial performance. We're not talking about them, but you either have done it, are doing it, or will do it. You may or may not have this slide with you, but one number I'm going to read it out just for those that can't see, because you'd have to have really good eyesight to see it, I would imagine. Down the bottom there, not quite at the bottom, there's the statutory loss for the year. So for Qantas, their full year loss in 2014 was close to $3 billion. We'll talk more about why that happened and why that was so large over the next 2 weeks, because there are reasons for it. But negative $2.843 billion was their loss. Now, when we talk about profit, that's the number we talk about. It's the bottom of the income statement. But there is a twist to the tale, and that is, if you flip to the next page, and I know I didn't actually put it on the slides, but if you have the income statement, or if you have the statements with you, if you go back at home, if you're looking at your bonus assignment company, the next page is actually quite important. Which is the statement of comprehensive income. Because ultimately, what is the wealth effect for a company is what is down here, which is the negative 2.9 billion. It's not that much different, it's a little bit. But that is ultimately what affects the overall equity of the business. And we actually start with statutory profit up the top here, and then we make all these, it's not a huge number, but we make these adjustments, and we end up with your comprehensive income. Now this is important, because when we talk about something hitting profit, it hits on the previous page. When we talk about something going through what's called other comprehensive income, or OCI, it comes into here. Now, why that's important is when you look at profitability, when companies are interested from their management remuneration, when people are paying attention to how well they did, they're not looking at this number, they're looking at the previous number. So that means there is incentive, if you can do so, to shift profit effects into OCI. especially negative profit effects. Because if you can shift something that's negative into OCI, your profit still doesn't get affected by it, but your overall wealth does. We will talk more about OCI over the coming weeks, but we will see OCI effects next week in revaluations. We see it in foreign currencies. We see it in financial instruments. It crops up a lot. So week 7, when we talk about employee benefits and superannuation, it crops up there. In week 9, when we talk about foreign currencies, it crops up there. When we talk about financial instruments in week 10, it crops up again. OCI features a lot. I'm just flagging that now. All right, so framework definitions of income and expense. Okay, income is increases in economic benefits during the accounting period in the form of inflows or enhancements of assets or decreases in liabilities that result in increases in equity other than those relating to contributions from equity participants. What you'll notice in there, it doesn't really talk about sort of doing work for someone. It is very much a balance sheet idea. Income is changes in the balance sheet. It is you're basically getting your equity going up through assets going up or liabilities going down. That starts to play a feature as we roll later on. There's no split between revenues and gains in that idea. It's just literally your equity has gone up. Now revenue they talk about in the course of ordinary activities of the entity. So for Qantas, their ordinary activities is getting people around the world on planes. So if they're making money off selling tickets, that from a framework idea would very much be revenue. Gains are things which don't generally fall in the ordinary activities. So Qantas selling planes, I mean, I'm assuming they do from time to time. That's not something they are known for. It's not their business model to be buying and selling aircraft. So if they make a gain on an aircraft sale, it would be a gain, it wouldn't be revenue. But for Airbus or for Boeing, same thing, they're selling a plane, but they would see that as revenue, not necessarily as a gain. So you can have the same thing for different companies be treated slightly differently, depending on the incentive and what their business model is. Now, if you can, I don't know if it's depending on how it's set out on your pages, it's a good idea to almost put these side by side. And this is the benefit of the framework, is that pretty much when I made this slide, I could take the last 2 slides back, copy it across, and then just change a couple of words. And it's the same in terms of setting it out. All this is just reversing from increases to decreases and just flipping the signs for everything. The terminology, the wording is going to be really similar with this sort of stuff. So expenses are just literally your equity is going down. And that's through asset depletions or incurrences of liabilities. When we see the standards and when we see similar asset standards, we'll see the wording be much the same. When we go today and we'll see revenues and construction contracts, the wording, the ideas are pretty much the same, which makes your job way easier. Doesn't distinguish between expenses and losses, and I'm pretty sure everyone's about 2 steps ahead of me here. Expenses are the ordinary things. Generally speaking, expenses, I mean, they talk about losses there as well, which is a bit weird, but it's generally the ordinary stuff, while losses are generally the things which don't happen in ordinary things, which again is what we'd expect. Now, does anyone care about profit? Because, and not just, companies want to make money. Like, that's the whole point of business. I suppose more to the point is accounting profit. When you have a financial statement that comes out, is that important? Does anyone care? It is. We wouldn't be here otherwise. But we see it a lot in terms of media attention on the bottom line. Like, look, we've just had reporting season. We've just had, well, the half-yearly reporting season. And you see profit talked about everywhere. You don't see them necessarily talk about the number of assets in the business or other factors which are going on, but you see profit numbers all over the place. There is a bit of a fixation. There's a caveat, though, which we'll come to in a few slides. We also see an association between profit and stock market returns. Now, even though that seems like a pretty self-evident outcome, researchers only actually identified this in the 60s. So it's not that long ago that people assumed it was the case, but actually kind of looked at it and went, well, does this actually link together? Intuitively, it makes sense. You make money, your price should be going up. You lose money, it shouldn't. So Ball and Brown, two Australian researchers working over in the US, actually were the first people to look at this. And we'll talk about them in a slide. The counter argument, which is pretty much anyone who doesn't like accountants, which is basically you can make up whatever number you want, is what is set out as a measure of profit can never supposed to be a fact in any sense at all, except it is a figure that results when the accountant has finished applying the procedures which he adopts. Okay, given we're going back to 1929, we'll forgive the he in there, but it's this idea that accounting is basically rubbish. You can just make it be whatever you want to be. Now, what we'll see in this course is there is some element of truth to that. You can have a funky ringtone. You can make adjustments to things. There's a lot of subjectivity in it. We're going to see examples of that. We're going to see a couple of quite large ones today. Actually, one, I think. But when it comes to sort of the Ball and Brown study, what they were looking at is what happens if there are unexpected, the company reports unexpected earnings. What happens then? Now, if you've done finance or doing finance or understand the efficient market hypothesis, that the market will price those things in. What happens if it's unexpected or supposedly unexpected? And what they find is this graph here. And what they've done is separate the companies out into different groups. So these were companies with good earnings surprises, so they actually surprised the market on the positive side. So it's like when you've sat that exam and you just convince yourself you did rubbish and you come out and go, hey, I passed, I did better than I thought. That sort of positive surprise. That's the one where you've done it on the worst side. Now, firms with good earnings, market returns go up, which is what you'd expect. It's not surprising. You'd expect companies who outperform what was expected to push up. You'd expect companies which have performed worse to push down. But most of this vertical line here is the release date of the information. A lot of that run-up actually still happens before the release date. Now, it's not something to answer now, but it's something to think about is what we're talking about here is the information environment around a company is the annual report the only way you get information about a company? And if it isn't, which it isn't, how else do you find out about how a company's performing? What are the other channels? Again, it's just something to think about over the rest of the semester, but the annual report is only one way in which companies release information, or even information is found about companies. There are other alternative methods. Now, incentives to adjust. So there are a variety of incentives for management to do this. One of them could be to meet or beat analyst earnings forecasts, and we're going to talk about this. So there's some academic work, but this is an example from a month ago, or a little bit, about 3 weeks ago. Seek, employment, anyone, I would say has anyone used Seek, but have people heard of Seek? Okay, maybe a few people. I think it's an employment search company. Underlying net profit after tax rose 9%. So profit went up. Underlying revenue went up 17%. Seek delivered a record half-year net profit. Profits have gone up, revenues have gone up. It's made a record profit and its share price got flogged. It came out when the day that it released its earnings, its share price got hit by nearly 9% on the day. That's not on a year, that would be bad on a year's basis. On a day it went down 9%. And the reason it went down 9% is because the market had built in a bigger profit than what it reported. So imagine, and so thinking about analysts, some of you guys may be working with people who are analysts, many of you may well go out into these sort of roles. The idea of an analyst is you'll have your portfolio of companies that you're looking after and sort of researching. I wouldn't say becoming one with, but you get to know them fairly well. And it's your idea to basically look at them and come up with targets and what you think they're going to do in terms of profitability, whether it be as an actual net profit number, whether it be EPS, whatever it happens to be. Now, the consensus forecast is when all of you guys were analysts on Seek, you'd probably have different expectations of what would happen, and we get a consensus, we'd come out with that number, and that consensus for SEEK was 101 million, and they missed that. And because they missed it, the market, as the analyst, you're telling your clients, people are aware of this, there are reports going out, people are building in the fact that they're expecting to make 101, and they miss it, and the market reacts negatively to that. You don't want to miss these things. Issuing new equity. So if you're going out with an IPO, if you're going out with an existing company with a seasoned offering, there has been some research evidence to point out that you will start to play around with things. If you've got management compensation contracts, we'll talk more about that in a moment. If you've got debt contract clauses, so if you've got debt if you've got debt and you've got contracts where there are earnings numbers in there somehow, you're going to do things to make sure you don't breach those contracts. Just like we saw with St. George Illawarra last week. So with Healy 1985, now you're going to have to get your thinking caps on because I'm actually going to ask you guys a couple of questions about this. So Healy 1985, he's over at Harvard or MIT. He's a Kiwi researcher, although I think a lot of Australians seem to sort of pseudo-adopt him, which we seem to do with every good Kiwi thing that comes out. They're partly Australian. If they're not, they're still Kiwi. The effect of bonus schemes on accounting decisions. Now, what they were looking at is, or what he was looking at, did the existence of a bonus plan mean executives manipulated profits? And what he found was, yes, it does happen, but it was actually a little bit more complex than just let's punch everything up to get the numbers up. And that's what we're going to explore right now, if I can make this work. Ooh, go back. Okay, so what we've got here is three hypothetical situations. We'll work through them one at a time. Now this is very much a simplification from what was going on there, and it's very much a simplification of how these actual plans work in practice because they're often quite complicated. Have a look at Qantas, have a look at the companies that you're looking at. You may be able to get some sense of some of the targets. There are short-term targets, there are long-term targets. They're not always as cut and dried as just make $100 million in profit and above that you'll get a cash bonus. It is more complicated. But to simplify, we got a situation where you're working at a company, there's a $100 million point in profit, you hit that, you get a $500,000 cash bonus. Now, if you come in, when everything's been looked at and dealt with and you come in just under, you just miss it, like poor old Nicholas Manza with 1 second over his time. You've got kind of three choices you could make. You could leave it as is, you could push your profit down a bit, or you could push your profit up a bit. Essentially, those are the choices that we've got available. What do you think somebody would do in that case?
Increase the profit.
Increase the profit. Yeah, and that's what they find. They will push it up. If you're close, but just under, you'll push it up a bit. So where is it? There is, this is wide-ranging evidence, so there is some evidence that this happens. What happens if you're up at 120? So you've smashed through it. Yeah, we could leave it as it is.
Reduce it?
Yeah, it could reduce it. Why would you reduce it? I mean, isn't that making us look worse off?
That's tax.
Could be a tax issue. And that's a really good juncture to talk about tax. So thank you for raising that. Tax is an issue. If you're reading the press over the last 18 months, you'll see that tax and tax minimization and tax non-payment is a big issue. Accounting rules and tax rules are different. So for our assumptions, tax doesn't play into anything that we do at this point because we can start doing things with accounting, and it's a fair point that you raise. We can start playing around with the accounting numbers and it won't affect our tax numbers one bit. There are things you can do to minimize tax, and that is a concern. But for our point of view, tax then doesn't become an issue with what we're looking at. So given that, there are still evidence that you will reduce it. So can anyone help them out as to potentially why?
So your target next year is not as high.
Why would you, and that is going to be a factor, why would you target next year not be as high?
So then next year, because if they can't hit that profit, they'll reduce it.
Yeah, that's getting it. Think about how expectations are built. Think about, I know we're going back to the rugby league. Think about South Sydney this year. They're expected to win it. They came first last year. Anything, they have to win it because otherwise they'd be missing out expectations. You come in, miss the finals and come in 9th, pretty much as long as you come 8th or higher, you've done better than what you did last year. So if you can push things down a bit, it makes next year easier to get. Yes?
So it's all about not over-promising and under-delivering in that case,
Yeah, absolutely. And that is very much a reason what goes on. There is an element of game playing with the market to sort of, they're coming with expectations of what you can do. So you're trying to manage those expectations so you can make sure that you can hit that next time. So absolutely. So that management of expectations plays in. There is something else though.
You could drop a few millions and keep them up your sleeve for next period.
Yep, exactly. We could push revenues out potentially. There's different ways you could do this. If you push your profit down or pull your profit down this year, mechanically, unless you're just making it disappear, which they're not going to want to do, you're pulling it down this year to push it into next year. So that means you're making next year easier because you've already got a running start, and because you manage expectations a little bit, the expectation of where you need to get to is lower as well. So you're actually getting a double effect from that. So there is actually some incentive to pull profit back a little bit, which seems counterintuitive, but it is there. And the last one, what happens if you're down here? If you made like an $80 million profit, for example.
Increase it.
Okay, we could increase it a lot. Do you reckon we're going to be able to get it up above 100 to make it worthwhile from a bonus perspective? Probably, well, we probably could, but we're probably going to get caught. So we probably can't really do anything to get us above that 100 without getting stung. So given that, that doesn't seem like a tractable situation. So what else do you think we could do? Yeah, who said leave it? Yeah, we could leave it, and that is a viable option. We could leave it as is. We could also pull it back a little bit. Now, you've got to be careful then, because if you pull it back enough, you may look like just bad management and they may get rid of you. You may become a takeover target. So it's managing things a little bit at that level, but there is no incentive at this point. And then where becomes close enough is difficult, but there's no real incentive when you're way away. You may actually pull things back a little bit. Either way, there are differences that can go on. Now, just on a side note, coming back to the managing expectations, that sort of profit over time is what companies would love to see happen. If you can get nice, smooth earning increases. Because it shows you know what you're doing, it shows you're sort of managing things nice and well. It just looks good. If you're seeing sort of profits kind of all over the place like that, if you were to sum them up, maybe they're equal exactly the same amount, but it shows you may not necessarily be absolutely on top of what's going on. So smooth earnings is actually a desirable feature that markets like, because then it makes your job as analysts easier to kind of pick what's going to happen next year, because they've just been stepping it up each time. Just makes it easy. Incentives to adjust. You don't have this slide. Appreciate that. All of you have done business statistics? Yep. Assume most of you have done business statistics. What does that look like? Yeah, it looks like a normal distribution, but there's something wrong with it. There's a little chunk just here. There's a little chunk taken out here, and it looks like it's been pushed up over that line. Now, what that line is zero profit. It looks like from research evidence that there is some suggestion that companies, if they're coming close to making a loss, will kind of tip themselves over the line. But really, if you're going to make literally, not in EPS, like a $1 profit versus a $1 loss, like that shouldn't make a difference, but it does. And I can give you a really good example of why that does. At the end of this semester, we all wrap this subject up, results come out. 49, I'm hoping none of you fall in this boat, 49 or 50. Which is a better number to get? It's not a trick question. Which is a better number to get? 50. So the difference between 49 and 50 is monumental as compared to the difference between 50 and 51. Only 1 mark each way, but that 49 into 50 tips you up, and make sure you don't have to see me again for another semester. And you'll be seeing the same, I would say jokes, it's really up to you whether or not you consider them jokes, but the same stories, the same ideas. So it is an important thing. So it does play a fact. Companies making losses, they don't like that. So if they can get close enough so they can just kind of get over the line, they will. Not all. A lot still are in that boat here, but a few seem to have tipped over. There's more. And this is something which is becoming increasingly prevalent. And it's something for you guys to take note when you're out talking to people about this sort of stuff or just reading the papers, because pretty much this is what you see in the papers. And on some level, it really frustrates me. Because it's not just taking accounting numbers and adjusting them. It is literally just telling us something completely different. So when we talk about non-GAAP earnings, and GAAP is an American terminology, but it's useful here just to talk about it as accounting numbers which are made through non-accounting standards. And so if you see something like underlying profit, if you see something like operating earnings or cash profit, that is not an accounting term. That is a term the company has come up with, and they may be forthcoming in how they've done it, and they usually are, but what it is not comparable across different companies, because they could well have made different adjustments to those numbers. So a couple of examples of this. Qantas recently came out a week or two ago with their half-yearly results. The number which you saw in the press all over the place was this number, 367, their underlying profit. But if we're doing the rules and using accounting numbers, their accounting profit was 203. What they do is take that accounting profit and then strip out various things, and they adjust it. And if you go through their annual report, they tell you exactly how they do it. But they're telling you that's nearly double the size of their accounting profit. Again, we're not going to necessarily answer this right now, but start thinking about why would a company do that? Why would a company tell you? It's not like they're hiding this number. It's still easily found.
To increase their stock.
It could well be to increase their stock, but what is it? People should still be able to find that information, and yet this is the one. If you look at if you look at pretty much all the press reports, they were focusing on that bottom number. So I would say it's around perception management, because you start seeing that and they're like, wow, they made nearly $400 million profit, not the 200 odd. MYOB, 2014 full-year results, their accounting profit was a loss. Their operating earnings, which you see discussed, was $138 million profit. Now again, there's a good argument, and I'll preface this, there is a good argument to be made for companies to be allowed to do this, because they are the best people to be able to ascertain what's going on with their business. If they think that's the best way to report, then in a sense, maybe we should let them do it. Regulators are trying to, regulators are global regulators. They're trying to do it for 120 different countries. It's going to be hard to fit exactly what is the best for a particular company. But you need to be wary, and you need to be aware that I can't just compare that 367 to the 138, because different things have been adjusted for it. Hey, can I just get you? Thank you. Now, an example of this, there was a Wall Street Journal article earlier this year, late last year. 18% of IPOs in the US last year, their operating earnings, or whatever they came out with and said, this is how we're doing, was a profit, while their underlying accounting numbers were a loss. It's something which is happening more and more, and it's just to be aware of. So regulation. Company reporting can be efficient or opportunistic. The purpose of regulation is to limit that choice, and the purpose of accounting regulation is to limit accounting policy choice. So we're not letting them have everything, the whole universe of possibilities. We're limiting that down to things which we think are relevant. Finally, after 1.5 lectures, we've actually got into the standards. This is a standard subject and it's taken us a while, but we're there. 118, AASB 118 on revenue. It's the first standard. We should be excited. It's the first time we actually get to open up the book and start looking at it. I hope you guys have got the handbook because it's useful to start looking through this stuff. This is from the textbook. It's actually developed from the research arm of the AASB going back about 20, 30 years ago now. But it's actually a really useful tool, and we're going to do a little task with this today because I'm pretty sure most of you would actually intuitively know what the standards are before we get to them. Because generally speaking, most standards are fairly not straightforward, but fairly logical. Primary issue for revenue. Primary issue is when. Because timing is, that's actually the whole point about accounting. And if you go back, way back when, periods of time are arbitrary. That's the whole point of it. If you go back to Dutch East India Company, when people used to go on sort of big sort of sailing, merchant sailing adventures, I don't know if adventures is the right word, it would basically be investors put money in, they'd go off, sell some stuff, buy some stuff, come back, sell it again, and then sell off everything on the ship and disperse all the profits. And if they made profits, so be it. But because companies are everlasting now, we have defined periods of time to say this is how you've done over that period. And as soon as you set up those defined periods of time, and we're starting to see incentives to perform in defined periods of time, there starts to be the case for moving profits between periods. So when becomes important. Now these are theoretical points when revenue could be recognized. Now before we get into that, I've got sound up so it should work. Okay, what I'm going to show you is a quick video. And just to preface this, I came across this when I was in the US a couple of years ago. Came out to Australia. Some of you may have heard of it. Some of you may have even tried this. But anyway, it serves my purpose. Have a look at it. It's only 30 seconds, and then we will talk about it.
What's up with chicken sandwiches? Big bun, puny chicken. It takes 2 to fill me up. Give me more chicken!
Finally!
Hello, chicken.
Someone was listening.
It's got 2 of everything. 2 pieces of cheese,
2 pieces of bacon.
and 2 pieces of chicken. So long, bun.
Now this is a chicken sandwich.
The new KFC Double Down Chicken Sandwich. So much 100% premium chicken, we didn't have room for a bun. Tried an original recipe or grill.
Hey, Colonel, you the man.
Unthink. It tastes the unhungry side of KFC.
It's nearly dinner time. Anyone hungry? Anyone buy it when it came out? How was it? Bit too much. Anyone else? Yep. Amazing. I did try it. It wouldn't be my favourite things, but you know, maybe they were just early on it's not strictly paleo, maybe they're early on this whole paleo, no grains thing, but I don't know. Now, the reason I bring this up is not just to get you guys hungry. May not get you guys hungry. But, where am I again? Okay, the reason I bring it up is because somebody in KFC R&D, I imagine they have an R&D division, thought about this and went, that sounds like a good idea for a product. Now, my question to you guys is, at the point in time where someone comes up with an idea, whether it be for a burger, whether it be for a product, a physical product, should a company be able to recognize revenue at that point? No. Seems like a bloody stupid point in time to do it. And you'd be right, it seems like a strange point in time to do it. What about when you're buying the inputs for said product? Does that seem like a reasonable point in time? No. Again, that seems a bit strange. What happens if, and I know for a burger situation, it's obviously a very quick time frame, although you hope it's quick between making the thing and you buying it and eating it. You never can tell. Receiving an order. Someone's put in an order for a product. I put in an order for those robot toys basically this time last year, and that took sort of 8 months to turn up. Can that company recognize revenue when, say I hadn't paid for it, can it recognize revenue when you put the order in? Ooh, tension. Good. It's good to start thinking about this. Commencing production, you're starting to build it. You may or may not have got orders yet. When you're building something, can you recognize revenue? Seems a bit strange. You now have a finished product ready to go. You might receive orders later on. You've delivered said goods. You may or may not have received cash at this point. Does that seem like a reasonable point in time? I hope everyone's thinking about this. What about receiving the cash? Okay. So we're going to get into what we actually are required to do. But these are all legitimate points in time on a cycle where you could arguably recognize revenue. For a product sale, when you're actually selling something or you're providing a service, it may be on a certain point on here. What happens if you have an investment property that's sitting there and generating, it's going up in value? You're not selling it, but should you be able to recognize income on it, or should you be able to recognize a gain on it? But you're not selling it, you're not receiving cash. You don't even have an order for it. So how does that fit in? So it's useful to start thinking about these things in that sort of frame. When do you think it could happen? Now, so the regulation stipulates, and we break it down into goods and services. So for a good, it's a physical good, bottle of water. Who's someone close? What's your name? Alex. All right, Alex is going to buy my bottle of water. Just hold on to that. Now, mate. Well, we'll talk about that in a second. So I've sold this bottle of water to Alex. Now, for me to be able to record that as a sale and record revenue from that, 4 things have to happen, all 4 things. One and two actually kind of link together. Alex now has the risks and rewards of ownership, and he has control. Not necessarily title. He has the risks and rewards of ownership, and he has control of it. If he wants to throw it at me, he could do that. If he wants to drink from it, he could do that. He has control over it. He's not going to do either of those because I'm asking him nicely. But he could do that. Those are important things to have happen. Thirdly, I've got to be able to measure the revenue and associated costs reliably. I need to know reliably, doesn't have to be perfect, but reliably how much that cost to make. And I should know how much I sold it to you for. If you don't know how much you're selling something to someone for, you probably shouldn't be in that business. But I need to know how much you're going to give me for that. So let's say it's a $2 sale. And the last one is also important. And this relates to cash. Because it doesn't anywhere say you have to receive the cash. Cash actually has nothing necessarily to do with it. What it is, I look at Alex and go, I think he's okay for it. He looks like a reasonable stand-up bloke. The inflows are probable. Doesn't say certain, doesn't have to be 100%, but I believe that he is going to pay me. Doesn't have to have happened yet. If I can satisfy all 4 things, then I can record that sale. And so that is an important characteristic of when revenue can be recognized for a sale of a physical good. Or a sale of, sorry, I shouldn't say, sale of a good. Okay, thank you. And you didn't drink from it. Is that what you were suggesting you were going to do?
Yeah, that's what he suggested.
Leading you astray. Don't worry, I don't think I'm sick at the moment. Okay, services. Services, similar but different. Services actually work in a much the same way. And we can actually see down the bottom there, those 2 blocks are exactly the same. And that would make sense because they're actually related to much the same thing. But the difference is, if I'm providing a service to somebody, sorry, what's your name? Kevin. If I'm performing a service for Kevin, it could be I'm providing tax accounting services. I could be building him a website. I could be a PR agent and doing some sort of PR or marketing or whatever. I'm providing a service to him. I'm not selling something which he can then control in that sense. So it's not like you gain control of a thing. It's not like you get the risks and rewards of ownership. What I need to be able to do is reliably measure the stage of completion. I need to know how much of that job I've done. If I can't, then we have a problem. But if I can, so if I'm doing him some sort of tax service and I know I'm 50% of the way through the job, then I can record 50% of the revenue. How much? Revenue should be measured at the fair value of the consideration received or receivable. What is important here is what you're getting, not the value of what you're selling. You see, I haven't actually seen one for a little while, but those Persian rug manufacturers that always seem to be going out of business and having sales, and they're selling stuff at 25% of price. When they make a sale, it's not whatever the actual price was and the value of the thing. It is what they're selling it for and what you're going to get, which is important. So it might be a $1,000 item which you're selling for $250. It's the 250 which is the revenue. Now, fair value is something we will talk about in a lot more detail in week 4. But fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. This idea of an orderly transaction is important, especially when you start to see dislocations in markets like what we saw about 7 or 8 years ago. If it's a fire sale situation, that may not necessarily give rise to fair value prices. But again, 2 weeks' time, we'll talk about it. How much? Okay. Kevin. Where's Kevin? Yeah, it's hanging. Yeah, it was Kevin, wasn't it? Yep. Okay, Kevin. Now, I'm not providing him tax services. I'm building him a website. I'm an accountant, so I'm probably doing a pretty rubbish job of it, and I probably don't really know what I'm doing, which means I probably don't know how far through the job I am at the end of the financial year. But being an accountant, I do know when the end of the financial year is. When I don't know how much I've got of this job to go with Kevin, when the outcome can't be reliably measured, I can only recognize revenue to the extent of expenses incurred and that are recoverable. So if I have spent, for argument's sake, $100 of expenses building this site for Kevin, I have no idea what I'm doing and where I'm at, I can record at most $100 in revenue, which means at most, how much profit can I show? Not, how much? Zero, whoever said that. If I can show at maximum $100 against $100 expenses, I show zero profit. So at most, I can show nothing. At worst, I show a loss. And that kind of makes sense. If you don't know what you're doing, you shouldn't be able to record revenue at that point. If you ultimately end up getting it done and making profit on it, well, fair enough. But at that point in time, until you finish and you don't know, then you leave it. A few more examples in there: sale of goods, rendering of services. But even as a small side note, even something as simple as, and it's maybe relevant for you guys, if you guys have probably been at work, it's been a long day. It's been a long day for me. It's been an 8 o'clock start, so it's already 2 coffees down. Coffee loyalty cards. So if you buy a coffee for $3 and then you get the 10th one free, should they be recording $3 as revenue for each coffee and then no revenue for the 10th? Or should they be recording $2.70 for each coffee and a $30 provision for that 10th free coffee? I don't know. Anyway, that's a really, even something as simple as loyalty cards can actually start to, there's accounting consequences of that you may want to think about. I'm sure, I mean, they're a cash business, so they're not going to be worried about what we're doing. But there are things to think about. You disclose a whole bunch of stuff, accounting policies adopted, amount of each significant category of revenue, and so on. Right, construction contracts. How are we doing for time? Good. 111 construction contracts. Now, hopefully I saw somebody, you guys have just been out to the co-op or something, you guys have got some textbooks, handbooks. When you're doing this, it's in a really efficient way. If you're starting to read the handbook, read these two together, because you'll see you can pretty much do it almost as one, because same ideas, same terminology, almost the same paragraphs. Makes life easy. The primary issue in accounting for construction contracts is the allocation of contract revenue and contract cost to the reporting periods in which construction work is performed. Simple, long-winded, but the simple idea is when. That's pretty much the summary of all that, is when do you record construction revenue and expenses. Now, if you think of construction as being a physical thing which you're handing over and selling at the end, then you're kind of going down the goods path and you should wait until you have delivery. But if you think about construction being a service side idea, then you're looking at stage of completion because the builders are providing a service for you. And so they may take 2 or 3 years to get something completed. Barangaroo is going to take a little while. The Geary building took 2 or 3 years. So they shouldn't be forced to keep revenue until the very end. They should be allowed to show a certain amount each year. What we're going to do is run relatively quickly through the requirements in the standard, and then we're going to look at an example of how we do some of the numbers. So some of the definitions: revenues, initial amount agreed to pay plus any variations, measured at fair value of consideration received or receivable. Same idea as what we saw previously. Costs, think about this almost from a kind of management accounting, CMS, MDC, direct costs, overhead costs, basically what you see up there. Okay, we're still getting this outcome reliably, outcome not reliably measurable, which is important. Okay, so when the outcome can be estimated reliably, contract revenue and contract costs shall be recognized as revenues and expenses respectively by reference to the stage of completion at the end of the reporting period. I hope I'm not going to run over a slide here. Okay, cool. It's very much about percent. That's what we're about to go through the practical question. But if we've got a 3-year period or 4-year period, 10-year period, whatever it is, we're trying to figure out how much to put in here, how much to put in here, and how much to put in here. Now the difficulty is, and it's not going to be as difficult for the question that we've got because it's a simplified question, but when you're at this point, so if you're actually here, you don't know the future. It's the future, that's the whole point. You can estimate the future, you can have an idea of what's going to happen, but you don't know it. So as we step forward, and we're here, we know this has happened, this is in the past now, but this is all estimated. But that's going to potentially affect what should have happened here. And we'll see, we're not going to exactly see it today, but basically once this is done, we leave this. We don't touch this again. We deal with it and we move on, and then if adjustments have happened, these affect these 2 years. We move on, this is now known, we deal with these 2 years, this is forecast, until we finish the project and we're all done. Now this is an important thing when you're getting information for questions, whether it be what we do today, whether it be tutorial stuff, whether it be exam, is just by the very fact that we give you all the information all at once is not how somebody would see it in reality. In reality, when they're at this point in time, all they can see is this stuff which has happened in year 1. When they get to this point, they can only see the stuff behind them and they're estimating what happens in the future. So that's an important consideration to take into account. I'm going to work off these slides, but I just want to show you the document that we're working off, and then hopefully everyone has this with them, but I'm going to work through some of the elements of it elsewhere. What the? Okay. Okay, above the line is what you could get in a question. Below the line is all the work and everything else. Now, what we see here is we're dealing with fixed price contracts. We'll only ever deal with fixed price contracts in this subject. It just makes everything a little bit easier to work with. When we're talking about a fixed price contract, it means you've signed up with someone and you're going to deliver that project for that price. So with this $9 million, the client will give you $9 million. If you get that project in at $3 million cost you, happy days. If you get it in at $20 million cost you, well, tough luck. $9 million is what you're getting. what we're looking at is a situation to figure out how much profit and arguably how much revenue to put into each of those 3 years. Now I'll say this, and I'll say it again and again with this subject as we go through various practical areas. Timelines are going to be your friend with this. It just makes life a lot easier if you draw up timelines. So what we're trying to do is effectively spread out the $9 million contract revenue across these 3 years. We're also going to spread out whatever the costs are across these 3 years, and we're going to end up, by nature of doing that, ending up with a profit across those 3 years. This information, so this is the $9 million, that's the known information about how much we're getting. That $8 million is a red herring. It's not useful for what we're doing. It just so happens in this case, it is the same as what was actually spent. But it is rare that reality actually ends up being what you expected it to be. So at the end of the 30th of June 2014, and this is what I'm talking about, at this point in time, you don't know what 2015 and 2016 look like. All that you know is that you spent 2 and it takes you 6 to go. 2015, you spent 5, it takes you 1 to go. And then at 2016, you spend 1 in that year and you're finished. We also get told that XYZ bills the client $3 million at the end of each financial year, end date, and receives the money that day. Okay, now that's not really all that realistic, but it just means for just a slightly easier transaction. So the thing that what we're going to work through, and I'll just do it in a slightly different place so I can do some working, is you're not going to get given something like this. This doesn't even have to be necessarily the way that you do it. What you have to be comfortable with is what we're trying to achieve from doing this. And if you're comfortable with that, then everything else kind of flows out. Oh, it's not touchscreen. So if you've got, I'll put up some of the information again, but if you've got that information in front of you, what we're worried about is we have so this is year 1, price of 9 million. Now cost to date, what are they? Okay. Bloody hell. Got that all wrong. 2 million. Now what you've been given in information is what you spent that year is $2 million. So cost to date, this is an important point. Never, always do it as from time 0 to time wherever you are. So from time 0 to time n, which is where we are in year 1, that's $2 million. Expected cost to complete are 6. That gives us, we just simply add those two together, that plus that. So at the end of year 1, we're still working to expectations. We still think it's going to cost us $8 million to finish this thing. And so that means, based on how much we're getting for a contract price, our estimated profit is still $1 million. We still think we're going to make $1 million over the course of this project. Now we can't record that entire $1 million in this year because you've still got another 2 years to go. So this is where the percentage complete comes in. Percentage complete, in this case, we're always going to use cost. So we've spent $2 million to date, and it's going to cost us $8 million to complete. So 2 of 8 gives you 25%. We're 25% done. We can record 25% profit this year. And so profit to date, actually we can record 25% profit to date, but because this is year 1, that's okay. So that is $250,000 because it is this 1 million times by where what total percentage complete we finished gives us 250. So profit in the year is 250. And the reason it's 250 is this is the first year we've recorded no profit previous to this. when we come to year 2, the cost to date are now 7 million. Because the information that you have is you spent $2 million in the first year and you spent $5 million in the second year. So the total cost, and that's what's important here, is always do it as time 0 to time n. So look at how much you spent from the start of the job to whatever financial year you're up to now. Don't just work on, we spent $5 million this year. Do it from the start to the end. Spent 7 million, we expect another 1, so we're still at 8. Estimated profit is still 1 million. Percentage complete, 7 divided by 8. $7 million spent divided by $8 million total cost gives us 87.5%. That means from time 0 to time n. That's not this year we're working on. We're working on the whole thing up to this point is 875,000. That's not profit this year. That is just profit you've shown in total on this project, which means the profit for this year down here is this minus whatever was previously. And so you're taking away the total profit which you've shown in the previous year. The reason that is important doesn't come out in this example because everything happens as expected. But as soon as you start having expectations, what happens change, you'll get completely thrown off if you do it just year by year percentages. Always work out the total percentage complete and then work out the profit and then take away what's been done previously. I'd urge you to go and have a play around with those sort of questions, and we'll release some on Excel and just see how doing it different ways will come up with the wrong answer, I suppose. So that gives us 625,000 for that year. In year 3, we spent 8 million. We've got 0 expected, gives us 8 million. Profit is 1 million. We're 100% complete. Profit to date is, no, yep, no, it's not right. One more, there we go. Profit to date is 1 million, and that makes a hell of a lot of sense because you can see that it's cost us $8 million to do it, and we're getting 9 million. We have to have made $1 million profit on this thing, and all we're doing is dividing up that million across 3 different years. And the way which we've divided that is, just finish that up, is 250 here, is 625 here, is 125 over here. So it all works out, and that's kind of the point of what we're doing. So we spread these numbers out into different time periods. Now from there, and we'll go have a look at the journal entries in a second, you could just be asked, what is the profit in any particular year, which is what we've just done. You could be asked to do the journal entries, which is what we're about to look at. But as long as you're clear on what you're trying to do, doing it is actually fairly simple. But it's being clear about what you're trying to get out of this. Now in terms of the journal entries, I'll flick back to document camera. Okay, so that's just reworking what we did here. Now I'll just talk very quickly about what the journal entries are here, and I won't go through every single one because they're all very similar. This I've broken down, I've actually condensed 2 entries into one here. And those 2 entries are debit what am I, sorry. What am I doing? There we go, sorry. Just a little brain fade, I'll be back. There we go. Okay, so what would actually happen is when you build the client, you would debit account receivable credit progress billings. Progress billings is a contra account which goes against construction in progress. It's kind of like unearned service revenue, but doesn't appear on the liability side. It appears as a contra against CIP. Debit accounts receivable, you guys are aware what that is. So you'd see that happen, and then when they pay you on that same day, you debit cash credit account receivable. because it's all happening on the same time, I'm just debiting cash, crediting progress billings. So that is how much you bill the client, the $3 million equal installments. Debit construction in progress, credit cash. This is what you're building. The construction in progress is an asset, and it is the asset in which you're building for the client. What we're doing here is loading up what you spend in each year. So the 2 million, the 5 million, and the 1 is what you spent building this thing. Could be cash, could be accounts payable, whatever it happens to be. I've just called it cash for ease of use. This is what we've been looking at. For us, debit construction expenses is just literally looking at the number that we used above. So whatever we spent that year gets used here, and it gets used in that construction expenses account. So the 2, the 5, and the 1 is what we spend. If you actually work through and do this as a percentage complete, you'll see it also fits the percentage of the job that we've done. But I mean, that's a mechanical truism, so it should work out. What we just worked out was this: 250, 625, 125. This line is your profit. Revenue minus expenses. There is a way to do this, which is just percentage complete times 9 million. And if you were to do that, you'll see it works out as well. This is your profit margin. So your revenue has to be higher than your expenses by that much to give you that profit. So that's why your revenue's up here. So we've got 250, so a $2.25 million revenue in year 1, a $5.625 million revenue in year 2, and a $1.125 million revenue in year 3. Now, the question as to why we build it into the construction in progress is as follows. I know we're building a bridge, but I can't draw a bridge which would make sense. So I'm drawing a house instead. If that looks like a house. It might not. What we've initially loaded up here is 5 plus 2 plus 1, not in that order, but we've added in $8 million. What we are providing to the client is an asset worth 9. So what we're doing is taking them, this is all the cash and the labor and whatever else and all the various things that we've spent to build this thing, but we haven't added in the profit margin because what we're delivering is something worth 9. So we're adding in the profit effect from it, which is the 1 million. So in effect, we're adding another 1 on there. And so 5 plus 2 plus 1, which is the spend plus the profit margin, will give you what that asset, I suppose, is valued at. And then when you finish it, you'll have a $9 million asset, which you're giving over to the client or controller's passed. Debit progress billings, you get rid of this account, so you debit it. And this asset account, you get rid of it by crediting it and credit progress, construction in progress, and you've cleared it out. So ultimately, you've got $1 million more cash, you've got $1 million in profit over 3 years, and you don't have any assets on your books or any progress billings. Now, this is a simple example. And the reason for that is normally I'd have actually two additional examples in the lecture, but given we've lost half an hour off lecture time, we've had to scrap them. This is to get you up to speed, and there's some other comments I need to make about a few bits and pieces. We will provide support materials, and and I'll have workthroughs and examples of harder situations, but you need to be able to understand this, but don't sort of sit there as was, I suppose, previously been able to be done and go, I can understand this, as long as I know this, I'm good for the exams. That is not the case this semester, which I suppose is unfortunate, but it's the way that the timetabling has worked out. But we have a lot of support material and a lot of resources to help you with that. So it is a matter of just sort of getting your hands dirty. Okay, if there's not a reliable outcome, it's actually really similar to Kevin and the website I was building him, to the extent that I can only recognize revenue to the extent of expenses incurred. That's all fairly straightforward. How do we determine reliability? Again, is a relatively straightforward thing. I mean, for us to talk about, in reality, it's probably not as easy. We're going to focus on fixed price because it actually differs between the contract types. For fixed price contracts, I've got to be able to measure revenue reliably. So I've got to know how much, if I'm building this thing for Kevin, I've got to know it's $9 million. So if we're taking that example, I've got to know the $9 million number, at least from a reliable point of view. I've got to trust that Kevin is actually going to give me that money, which, you know, looks like a good bloke, so I'm assuming he will. And I need to know where I'm at with it. If this is the first time ever building job and I am not a DIY person, so it's highly likely I have no idea where I'm at, then that's a problem. Stage of completion, we use cost in this subject. So if you spent 2 and you've got $6 million to go, you're 25% done. But it can be done in a whole bunch of ways which are completely legitimate as long as you get them all obviously checked out. But think about you and this subject. You're 2 weeks in now. 2 weeks of 13, what's that? About 17% thereabouts. So one way you could say from a time basis, I'm 15, 17% done. On an assessment basis, you're 0% done because you haven't had any assessments yet. There are different ways to measure how much of it you've completed. What is important though is Kevin's payment record with me has no bearing whatsoever on determining stage of completion. If he pays me all up front, I can't recognize 100% profit or revenue. If he pays me all at the end, I'm still allowed to show revenue early on. So that's an important thing. And you can bet if we've got a construction contract practical question, you will see information which tells you how much you collect, and people can and will use that as percentage complete. Don't be those people. What happens now? We just don't have, I would really like to go through this as an example because it's a really important one and it's probably the types of ones you see in exams. But we need to step through the basic example before you could do this one. But losses work differently. If you're going to lose money on a contract, when it is probable that total costs exceed revenue, you're losing money, you might as well have stayed in bed instead of taking this thing. You recognize the loss immediately, the whole loss. And this is conservatism because when we're making profits or expecting profits, we show part of the profit until we finish it. But if you're going to make a loss, you show the entire loss straight up. It's asymmetric. It's not an equal treatment, good ways, bad ways. Now, we talk about examples of accounting irregularities, and I will preface this by saying alleged accounting irregularities because no one knows exactly what's going on here. But this is from about 3 weeks ago. So this is really recent. Some of you may work for Layton's, I don't know. But it is alleged, and I've linked to this on our social media, so I would highly recommend you guys having a read of this. It is an interesting article. It is alleged that Layton's CEO knew of major project blowouts, but intentionally chose to disregard their significance. Now, why this has become important is potentially this should have cost shareholders or should have been recognized, and you're talking about $4 billion as potential things which have been sort of screwed up here. You're not talking about a couple of million here or there, like this is a big amount of money. Now, what we're talking about is the fact that if you're holding up, if you've got this example in front of you, if you look at the information, what was spent, that is not a subjective number. What was spent when you're looking backwards, that is as objective as we can get. But what you think you're going to spend, that is a subjective number. That is management expectations about things. So imagine for the first year, we have 25% complete because we've done 2 million and we're expecting to spend another 6. 25% complete, we show $250,000 in profit. If they knew that was going to be a blowout, it could have been $2 million spend. What's a number I can work with? $18 million to go. That means 10% complete. I think that's right. You're 10% complete, which is a lower completion and you're making a loss. So your profit is going to come down mechanically. So if you start to change around the estimated to complete, it is going to affect absolutely your bottom line. And that seems, at least from an alleged point of view, that seems to have been what happened here. This stuff can and does happen, even in this day and age. As I mentioned, it's a good example of conservatism built into the accounting standards. Now, there's a couple of admin things I want to talk about just before we finish up, after I go through this, and then we'll get rolling with it. So, summary. Earnings are useful, which I like to think they are. I mean, certainly companies like earnings, but from an accounting point of view, people seem to take account of them. Management do have incentives to manipulate. Doesn't mean they always do, but they can. Accounting regulation limits that accounting policy choice. Primary issue is, I will hold you for about 2 minutes and then we can get rolling, so just everyone chill out for a moment. When? If there has to be one word for revenue, it's when.